The next tech boom is here, and fortunes are being made right now. Are you ready to capitalize, or will you be wishing you had gotten in sooner? Today I'm revealing 3 tech stocks poised for explosive growth in 2025. Companies flying under the radar, but already catching the attention of smart money and top analysts. We'll cover a quiet tech innovator, a digital transformation pioneer, and a new disruptor backed by a legendary entrepreneur. This isn't financial advice, just my research and opinion. Always do your own due diligence. The information in this video could be a game changer for your portfolio. So grab a coffee, get comfortable, and watch till the end. You won't want to miss these picks. Hit like, share your thoughts in the comments, and subscribe for more investing updates. Our first pick is ADEA, ticker ADEA, a company you've likely used today without realizing it. Whether you streamed a show, scrolled through social media, or used a smart device, there's a good chance ADEA's technology was working behind the scenes to make it all possible. ADEA isn't a flashy brand, but it's a powerhouse in tech innovation, specializing in intellectual property. While you may not see their name on consumer products, their inventions are embedded in the digital experiences we rely on every day. Think of ADEA as the landlord of the tech world. They invent and patent core technologies, then license them to giants in streaming, TV, social media, and semiconductors. Their intellectual property is the backbone for many of the world's most popular platforms and devices. Their business model is simple: focus on R&D, patent breakthroughs, and collect recurring high-margin revenue from industry leaders. This approach allows ADEA to generate steady income without the risks and costs of manufacturing or direct consumer sales. With over 10,000 top-tier patents, ADEA has built a defensive moat and strong pricing power, making it nearly impossible for competitors to replicate. Their portfolio covers everything from content discovery and recommendation engines to advanced chip packaging, giving them leverage across multiple tech sectors. Recent long-term licensing deals and a robust pipeline are locking in revenue for years. These agreements aren't just with small players, they're with some of the biggest names in the industry, ensuring ADEA's technology remains indispensable. Financially, ADEA is profitable, generates strong free cash flow, and even pays a dividend, a rare find in tech. Their consistent cash generation allows them to invest in new innovations while rewarding shareholders. The stock is undervalued compared to peers, and Wall Street analysts rate it a strong buy, citing its expansion into semiconductors and attractive valuation. Many believe the market hasn't fully appreciated the value of ADEA's intellectual property and its potential for future growth. As streaming, smart devices, and advanced chips proliferate, ADEA's foundational IP becomes even more essential. Every new device or platform that enters the market is a potential customer, expanding ADEA's reach and influence. Their multi-year contracts provide revenue stability, and their experienced management excels at defending and monetizing their IP. The leadership team has a proven track record of navigating complex negotiations and protecting ADEA's interests. The main risk is patent litigation, but ADEA's legal track record is strong, often resulting in lucrative settlements. Their legal team is seasoned, and the company has a history of successfully defending its patents, turning potential threats into opportunities. Their growing presence in semiconductors is a major catalyst, as advanced chip packaging becomes critical. As the world demands faster, smaller, and more efficient chips, ADEA's innovations are positioned at the heart of this technological evolution. Management is also shareholder-friendly, buying back shares when undervalued and returning value through dividends. This disciplined capital allocation signals confidence in the company's future and aligns management's interests with those of investors. In short, ADEA is an under-the-radar gem, a high-margin compounding machine with a massive patent portfolio and a clear path for growth. Their ability to innovate, protect, and monetize technology puts them in a unique position to benefit from the ongoing digital transformation. While others chase hype, ADEA quietly powers the digital world, and the market hasn't caught on yet. Their low profile means there's still time to get in before the broader investment community recognizes their value. You're not just buying a stock, you're buying a piece of the digital infrastructure that tech giants rely on. ADEA's technology is woven into the fabric of our connected lives, making it a foundational holding for any tech-focused portfolio. Top analysts see predictable cash flows, a defensive moat, and multiple growth avenues. With expansion into new markets and ongoing innovation, ADEA is set up for both stability and upside. ADEA currently holds a market capitalization of $1.58 billion. The company posted earnings per share of 77 cents, giving it a price-to-earnings ratio of 18.96. For 2024, ADEA reported revenue of $376.02 million and a net income of $64.62 million. At today's price, the market is underestimating ADEA's long-term earnings power. As more investors recognize the company's unique position, there's significant potential for price appreciation. ADEA offers value, growth, and income, a rare combination in tech. It's not just about short-term gains, It's about building wealth through a company that delivers on multiple fronts. Do your own research, but this is the kind of smart, strategic investment that can anchor a long-term portfolio. Adaya's fundamentals, business model, and growth prospects make it a compelling choice for investors seeking both security and upside. Check out their investor presentations and reports. The more you dig, the more compelling Adaya looks. Their transparency and communication with shareholders are another mark of a well-run company. This is a foundational pick for 2025. If you're looking for a company that combines innovation, stability, and shareholder returns, Adaya deserves a spot on your watch list, and maybe in your portfolio. Our second must-buy is Alight, ticker ALIT, a pioneer in digital HR and business solutions. Alight stands at the intersection of technology and human resources, transforming the way organizations manage their most valuable asset, their people. In a world where workforce needs are rapidly evolving, Alight's innovative approach is helping companies stay ahead of the curve. Alight's platform helps massive companies manage employee benefits, payroll, and wellness, streamlining complex HR tasks for millions. Their solutions are designed to reduce administrative burdens, improve employee satisfaction, and ensure compliance with ever-changing regulations. For large enterprises, this means less time spent on paperwork and more time focused on strategic growth. Their work-life platform is a one-stop shop for employees and a data-rich, cost-saving tool for employers. Employees can access benefits, pay information, and wellness resources all in one place, while employers gain powerful analytics to make smarter decisions about their workforce. This seamless integration of services is a game-changer in the HR tech space. With 36 million users and 70% of the Fortune 100 as clients, Alight's blue-chip customer base provides incredible stability. These are some of the world's largest and most demanding organizations, and their continued trust in Alight speaks volumes about the company's reliability and value proposition. The business model is built on recurring revenue from long-term contracts. Once integrated, clients rarely switch. This creates a highly predictable revenue stream, which is a major advantage for both the company and its investors. The stickiness of Alight's solutions means that customer churn is low, and the company can focus on expanding its offerings rather than constantly replacing lost business. Alight recently completed a major tech transformation, shifting to a scalable, high-margin platform model. This move to the cloud has unlocked new efficiencies, allowing Alight to serve more clients at lower incremental costs. The result is a business that's not only more profitable but also more agile and better positioned for future growth. The market hasn't priced in this shift. Alight trades at a discount to HR tech peers despite its superior fundamentals. Investors are still catching up to the company's transformation, which creates a unique window of opportunity for those who recognize the value early. Analysts rated a strong buy, highlighting the company's margin expansion and multi-year growth runway. As Alight continues to execute on its strategy, Wall Street expects both revenue and earnings to accelerate, making it a compelling pick for growth-oriented portfolios. Their BPaaS, Business Process as a Service offering, is in high demand, combining tech and expertise for fully outsourced HR solutions. This is especially attractive to companies looking to modernize their HR functions without building everything in-house. Alight's ability to deliver end-to-end solutions sets it apart from competitors who only offer point products. The total addressable market is huge, and Alight is perfectly positioned to capture more share as companies increasingly outsource HR. As digital transformation sweeps through the corporate world, the demand for integrated, cloud-based HR solutions is only going to grow. Alight's scale and expertise make it a natural partner for organizations of all sizes. Alight leverages its data to provide clients with actionable insights, making its platform even stickier. By turning raw data into meaningful recommendations, Alight helps clients optimize benefits, reduce costs, and improve employee engagement. This data-driven approach is a key differentiator in a crowded market. The management team is experienced, having successfully navigated the tech transition and now focused on profitable growth. Their track record of execution gives investors confidence that Alight can deliver on its ambitious plans. Leadership's vision is clear: to become the go-to platform for HR and business solutions worldwide. Risks around transformation execution are fading. Now it's about scaling and fending off competition, something their entrenched relationships help with. Alight's deep integration with client systems makes it difficult for competitors to displace them, providing a durable competitive advantage. As profitability ramps up, Alight is paying down debt, further de-risking the investment and attracting institutional interest. A stronger balance sheet means more flexibility to invest in innovation, pursue strategic acquisitions, or return capital to shareholders in the future. The market is stuck on the old Alight, but the new, tech-driven Alight is set for a re-rating as results come in. As quarterly numbers reflect the benefits of the transformation, expect sentiment to shift and the stock to revalue accordingly. This is a classic special situation, a misunderstood company at an inflection point, trading at a bargain. For investors willing to look past short-term noise, Alight offers the potential for significant upside as the story plays out. The broader HR technology sector is undergoing rapid change, with automation, AI, and data analytics reshaping how companies manage talent. Alight is at the forefront of these trends, investing heavily in next-generation capabilities that will keep it ahead of the curve. The company's market cap stands at $2.05 billion. In 2024, it generated $2.33 billion in revenue, but reported a net loss of $157 million. Despite this, the stock trades at just $3.76, which is 82.58% below its estimated fair value of $6.87. As Alight delivers quarter after quarter, expect the market to recognize its true value. Consistent execution and visible progress on key metrics will be the catalysts for a sustained re-rating. This isn't a get-rich-quick play, it's a bet on a fundamental business transformation just starting to pay off. For those with patience and conviction, the rewards could be substantial as Alight cements its leadership in the HR tech space. Do your own research, but Alight is a deeply undervalued growth story for 2025. The company's fundamentals, client base, and strategic direction all point to a bright future. Check their investor materials and compare to peers. You'll see why this is a top pick. The numbers speak for themselves, and the gap between perception and reality won't last forever. For patient investors, Alight offers a compelling risk-reward profile. The downside is limited by recurring revenues and blue-chip clients, while the upside comes from operational leverage and market expansion. Don't overlook this HR tech pioneer. Alight is quietly building the future of work, and those who recognize its potential today could be well rewarded in the years ahead. Our third pick is QXO, ticker QXO, a ground floor opportunity led by legendary entrepreneur Brad Jacobs. This is a company that's just beginning its journey, and for investors who want to get in early on a potentially transformative story, QXO stands out as a rare find. It's not often you see a new public company with this level of leadership pedigree and a clear, ambitious vision from day one. QXO is targeting the massive, fragmented building products distribution industry, aiming to consolidate and modernize it with technology. This sector is the backbone of construction and real estate, yet it's surprisingly behind the times, ripe for disruption by a player with the right resources and strategy. Jacobs has built $5 billion companies, including XPO Logistics and United Rentals. When he launches a new venture, Wall Street pays attention. His track record isn't just impressive, it's nearly unmatched in the world of business building. Investors and analysts alike know that when Jacobs steps in, he brings a playbook that has delivered extraordinary results time and again. QXO's strategy: acquire top regional distributors, integrate them, and build a tech-enabled national powerhouse. This isn't just about buying companies, it's about creating a seamless, efficient network that can outcompete legacy players and set new standards for the industry. The industry is huge, trillions in market size, but dominated by small players and outdated processes. Most distributors are family-owned or regional, lacking the scale and technology to compete on a national level. This fragmentation creates enormous opportunities for consolidation and efficiency gains. QXO's digital platform will bring e-commerce, pricing optimization, and logistics efficiency to an industry still run on phone calls and faxes. Imagine a world where contractors can order everything they need with a few clicks, track deliveries in real time, and benefit from transparent, competitive pricing. QXO wants to make that a reality. With billions in backing, QXO is set for rapid, acquisition-driven growth. The company isn't starting from scratch, it's armed with significant capital, ready to move quickly and decisively as opportunities arise. This financial firepower gives QXO a major edge over smaller competitors. The stock is essentially a bet on Jacobs' proven playbook: buy, integrate, scale, and create massive value. He's done it before, and the market is watching to see if he can repeat that magic in a new, even larger arena. The company has already made its first acquisition and more deals are expected to follow, each adding scale and earnings power. Every new deal not only expands QXO's footprint, but also brings in new customers, suppliers, and data, fuel for further growth and innovation. Analysts are bullish, rating the jockey as much as the company, and see QXO as a future industry leader. They're betting on Jacobs' ability to execute, and many believe QXO could become the dominant force in building products distribution within a few years. The timing is right. Housing shortages and ongoing remodeling drive long-term demand, while current market conditions allow for attractive acquisitions. As infrastructure spending rises and the need for new housing grows, the demand for building materials is only set to increase. QXO is higher risk than our other picks, but the upside is enormous if Jacobs executes as he has before. This is not a stock for the faint of heart, but for those willing to take calculated risks, the potential rewards could be life-changing. Even a small share of this trillion-dollar market could make QXO a $50 billion revenue company. That kind of scale would put it among the giants of the industry, and the stock price could reflect that transformation over time. For investors, each acquisition and integration will be a catalyst, potentially driving the stock higher as the story unfolds. The market loves a good growth narrative, and QXO's journey is just beginning. This is a rare chance to invest at the start of a major consolidation, led by a world-class operator. Most investors only hear about these stories after the big gains have already happened. QXO offers a chance to get in early. The value will be built over years, not overnight, but the potential for outsized returns is real. Patience and conviction will be key as the company executes its roll-up strategy and builds a modern tech-driven distribution empire. With a market capitalization of $10.63 billion, the company recorded revenue of $56.87 million in 2024 and net income of $27.97 million. The current share price sits at $18.82, about 5.21% lower than its fair value of $19.80. If you want exposure to a different kind of tech-driven growth, QXO is a compelling addition. It's not a pure software play, but it's bringing digital transformation to a sector that desperately needs it, blending old-school industry with cutting-edge technology. Study 𝗣𝗟𝗓𝗧 track record. He's repeatedly turned fragmented industries into dominant, high-return businesses. From waste management to equipment rentals to logistics, he's shown an uncanny ability to spot opportunity and execute with discipline. QXO is the next chapter in that story. For those who believe in backing proven leaders, this is a narrative worth following closely. For 2025, this is a calculated bet on a proven winner in a target-rich environment. The landscape is shifting, and QXO is positioned to capitalize on the changes ahead. Do your own research, but don't sleep on QXO. The early innings of a 𝗣𝗟𝗧-led venture have historically been the most rewarding for bold investors. This could be a portfolio-transforming pick. If you're looking for a high-upside, high-conviction idea for the years ahead, QXO deserves a spot on your watch list, and maybe in your portfolio. There you have it. 3 tech stocks analysts rate as strong buys for 2025, 𝗣𝗟𝗨𝗦, Alight, and QXO. Each offers a unique path to growth, from hidden tech infrastructure to HR transformation to industry disruption. The goal is to find value before the crowd does. Want to level up your investing? Check out my Value Stocks Investing Master Course. Link in the description. For exclusive tips and in-depth analysis, join the Stocks Galore Patreon community. Which of these 3 stocks excites you most? Let me know in the comments. Don't forget to like, comment, and subscribe for more investing insights. Thanks for watching. See you in the next one.